One of my members had 90,000 euros ready to invest. He looked at the stock market, which was at an all-time high, and said, it's too expensive. So he decided to wait for a better moment. 5 years later, he looked back and realized that decision had cost him more than 100,000 euros. And the worst part, he wasn't lazy. He wasn't stupid. He was just trying to be careful and responsible. In this video, I will show you why that careful and responsible decision is one of the most expensive mistakes in investing, why many investors keep doing it time and time again, and why the stock market at an all-time high is not what most people think it is. Now, most people think that when the stock market is at an all-time high, it means the market is very expensive and the crash must be just around the corner. So, you should wait for a better entry point. But this is the wrong mental model. An all-time high is not a danger signal. It is often simply proof that companies, profits, productivity, technology, and the global economy have grown over time. And yes, of course, central banks printing money also helped a little. Okay, maybe more than a little. But the fact is that market does not move from cheap to expensive and then stops. It moves up over time, with many corrections or even crashes along the way. Let me show you some interesting charts. If we take a look at any short-term chart or short-term period in the stock market charts, for example, this is S&P 500, and this was the Trump tariff scare of 2025. In March and April, the market fell almost 20% very, very quickly. And it looks scary because if you invest here at an all-time high, of course, immediately you are down 20%. Or if we go to this chart, this was the virus scare of 2020. We all know what happened back then, minus 30% in a very, very short period of time. So that was very, very scary period. And again, if you invested here or if you invested here, you are down sharply immediately. Okay, so it looks very scary. But when you zoom out, this is the long-term chart of S&P 500 from the year of 2006 till now. You can see this big uptrend, okay, with ups and downs on the way. And as you can see here, this looked expensive. 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 So the market is always expensive. It always looks like overvalued. And this is the thing. If you think that market is overvalued all the time, you will never start investing. Every past all-time high looks obvious today, but at the time it felt dangerous. It felt overvalued. But maybe you are thinking, okay, Robert, the chart looks good, but wouldn't it be better to wait for a correction to start investing? Now, let me show you something that will totally change the way how you think about this. JP Morgan analyzed the historical S&P 500 charts and found out that the market reached all-time high on about 7% of all trading days. And of these highs, almost a third became new market floors. So this means that if you missed that opportunity to invest, the market never went lower, okay? It only went higher from there. So you missed your opportunity to invest. Dimensional also did a very, very extensive study, and they found out that investing, so here they compared investing at an all-time highs versus all dates. And the differences are minimal. The differences are very, very small. So for example, average 5-year returns after you invest at an all-time high is 10.5%. And if you invest on any other day, it's only 11.4%. So it's not a big difference. This does not mean markets cannot crash after an all-time high. Of course they can. But history does not support the idea that an all-time high is a good reason to stay out. But the most important reason to start investing, even when the markets are at an all-time high, has nothing to do with charts. It has to do with human psychology. Because most people think they are waiting for a better price. But in reality, they are often waiting for a feeling of certainty that never comes. Let me show you how this looks like in real life. One of my members learned this lesson the hard way. Now, if you find this kind of investing content valuable, click the subscribe button under the video. I make videos that will help you improve your investment returns every single week. So, let me tell you about one of my members, and I'll call him Mark. He shared his story during one of my live member sessions. He joined my long-term investing program in 2012, and he had money ready to invest, around 90,000 euros. But when he joined, he looked at the market and the charts and said, "Oof, everything has already gone up so much. This was after the financial crisis. I'll just wait for a correction." And you could understand him. The market has already recovered very strongly after the financial crisis. The headlines were full of warnings. Europe had debt problems. People were still very scared. So let me show you how the market looked back then. So this was the market in 2012 when he joined my program, and he decided that the market is overvalued. Okay, so after the financial crisis, when you had this big drop, like minus 60%, the market already recovered quite a bit. Okay, it went from 680 to almost 1,400. So it made basically 100% returns for a few people who invested back here. Of course, nobody did. So yeah, it doubled in a very short period of time. And he decided to wait because the market felt overvalued. Now, what happened then? A very interesting thing. The market basically didn't give him the opportunity to get back in. Okay, so this was 2012, and he could start investing here, but he didn't. And he waited, and the market went straight up. So in 2014, the market was already at 2,000, and he was still sitting in cash. And what happened after that? The market went even higher. So by 2017, the market from here, from 2012, went up from 1,400, it went to 2,800, okay, and even more. So this is more than 100% gain, okay, more than 100% gain. And he was out of the market. His 90,000 euros could have grown to around 200,000 euros, but instead he stayed in cash. He did not lose money in an obvious way. There was no big crash in his account. There were no painful red numbers staring at him on the screen. But he lost around 100,000 euros in missed growth. And the painful part is this: he was not lazy. He was not stupid. He was not reckless. He was trying to be careful. He was trying to play it safe. He was trying to be responsible. And yes, his money was very safe because he was in cash. It was safe from volatility, it was safe from market crashes, but unfortunately also safe from growth. Sometimes the biggest investing mistake does not feel like a mistake. It feels like being responsible. Now, if someone you know is sitting on cash, waiting for the perfect moment to invest, share this video with them. Click pause and share it. It could save them from making a similar expensive mistake. Now, the fact is that people want to invest when it feels safe. But when the market falls and the opportunity appears, it does not feel safe anymore. When markets are down 30%, 20%, maybe even more, headlines are scary. And then the human psychology kicks in. What if it falls another 30%? What if I lose all my money? I will look stupid if I invest now. And people don't invest. So, they do not invest at an all-time high, and then they also do not invest during corrections or crashes. This is how people stay out of the market for years and miss out all the gains. The problem is not that people wait for lower prices. The problem is that when lower prices finally come, they are usually too afraid to buy. So, what is the solution? The most important thing is that you don't try to find the perfect day to start. The most important thing is becoming the kind of person who invests consistently, regularly. Because in investing, your habits are everything. My good friend and business partner, Brian Tracy, said it very simply. Successful people are simply those with successful habits. Successful investors are not people who magically know the perfect day to buy. They are people who build the right habit. Because if you plan to invest only when everything feels perfect and safe, you will probably wait forever and miss out on all the gains. That is why you need to develop a simple habit of investing regularly. Keep investing when the markets are high. Keep investing when the markets fall. Keep investing if Robert Kiyosaki predicts the biggest stock market crash in history for the 47th time. And keep investing if aliens invade. You do not build wealth by waiting for a perfect moment. You build wealth by creating a simple habit and repeating it for years. Think about fitness. Imagine someone saying, I will start exercising when my body is already in a better shape. Now that makes no sense, of course. You get in shape because you start, not because you wait. And investing works the same way. You do not become a successful investor by waiting until you feel confident. You become confident because you start. You follow a plan and you see the system working over time. Your investing habit will very likely make you more money than your ability, or maybe I could say inability, to predict the next correction. Now, this does not mean to throw all of your money into the market without thinking. You need a proper asset allocation. You need to understand the investments you are making. You need to keep the fees low. But if your plan is long-term, then all-time highs are not a good reason to stay out. One day, the market level that feels expensive today will probably look cheap. Just like 2012 looks cheap today. Just like 2020 looks cheap today. And just like today will very likely look cheap 10 years from now. So remember, waiting for the perfect moment feels safe, but building the habit is what actually builds wealth. So the better question is not, is now the perfect time to invest? The better question is, do I have a smart plan? Am I ready to follow it for many years and not get scared out of the market when the next correction hits? Now, if you are thinking, Robert, I understand the logic, but I still don't have a clear plan. And that is exactly what I cover in my free 90-minute masterclass. It is designed for busy professionals who want better investment returns with less effort. I will show you how to outsmart Wall Street without short-term trading and set up a simple investing system that can work whether markets are at an all-time high or in a crash. Now check the description under this video. The masterclass registration link is there, and like I said, it's free of charge. If this video helped you, click the like button and subscribe. I make videos every week for busy professionals who want their money to work for them hard, without Wall Street nonsense. See you in the next video.